it's created havoc and chaos around kind of political decorum
Oh, yeah.
and leaders dealing with leaders and leaders dealing with America and America dealing with other countries. Like, this is where I feel like maybe it could have been handled better. At the end of the day, I have less control over whether it's a circus or not. I am very interested to see what the end result is. And if at the end of the day, the result is positive, I'm not going to argue about there being a circus.
Hey, everybody. Welcome back to another episode of Wealth Unfiltered. I'm Samantha Parinello, your host. We just hit the halfway mark of this post-election year, and there is a lot to unpack here. From tariffs to the lack of movement in interest rates to the potential policy changes that we see coming, we have a lot to talk about. And to do that, I'd love to reintroduce to you my resident guest expert, Chris Parinello. Welcome back.
Thanks. Always a pleasure.
Wonderful. Well, like I said, we have a lot to talk about here. So I want to begin by talking about how the election impacted the economy. My first question for you is, how have the markets responded to the election results in the first 6 months of the year?
Yeah, I mean, I think, we were traveling during the election. We were on the West Coast for a business trip. And I remember thinking, how is this going to go? And the markets didn't really know what to do leading up to the election. A lot of seesawing. Once it was pretty clear that Donald Trump was going to win, I think that the markets acted very pro-business. They felt like there were potentially going to be tax cuts, and you could see immediately the market starting to price in growth.
Yeah, absolutely. So you talk about pro-business, the markets were starting to price that in, but what are some specifics that you remember from back in the beginning?
Yeah, I feel like the big thing, and a lot of this is really relevant today because you see the tax bill, incrementally making progress. Especially for real estate, the idea of bonus depreciation, the idea of long-term capital gains, O-zones, opportunity zones, getting restructured. There's lots of parts of that tax bill that positively affect real estate. And when the market saw that a Republican was going to be elected and it was going to be Donald Trump, and he is the one that introduced a lot of these policies in his prior term, they just move very quickly because no one wants to be late to the party in forecasting what's going to happen. People are trying to essentially get their seat to the growth before it happens.
Yeah, and we've seen quite the roller coaster
Oh, yeah.
as far as the markets are concerned. I mean, let's just talk about Tesla, for example. I think the first 30 days, we saw it almost double in what the value of the stock shares were worth. And since then, there has been a lot of turbulence in the White House with Elon Musk and Donald Trump, leading to a lot more turbulence with Tesla.
100%. And it's almost comical, right? Because like everyone's trying to create an edge. So Tesla relies on subsidies. One of its mechanisms, it's really been able to fuel some of its growth, being able to get tax incentives for using electric power vehicles and things of that nature. But you back up to the election, I think Tesla had kind of been on a little bit of a tear and a little bit of a pullback. Then Elon Musk becomes the face of Doge. And then it becomes, okay, maybe he's focused too much on the White House. Tesla has another bit of a pullback.
Mm-hmm.
Then, things are going well, and a lot of Republicans are like behind Elon Musk. Tesla kind of skyrockets. Some of that had to do with, we're going to talk about tariffs and other things, but Tesla's kind of in the middle of it. Meanwhile, you have people on the other side of the coin, like boycotting Tesla because
And extremists
yeah,
were like lighting cars on fire.
in some parts of the country, it might not have been safe to drive a Tesla.
Yeah.
So like polarizing views on how all of this has gone. And then now you have,
And being that it's a consumer market, we saw that in live action.
and now you have the Elon Musk Donald Trump breakup, which is, even more comical because, everyone knew, like I think everyone knew it was going to happen.
Right.
I think people really deep
This
down
unlikely pair.
thought that it was going to happen later. But you get two polarizing figures together.
Yeah.
There's some areas in which both of them benefited from that relationship.
I saw the most hilarious meme, and this is like taking this probably completely the wrong direction, but I couldn't help but like laugh. And I won't say who is who in this scenario because it doesn't really matter. I think it's funny either way. But somebody put the head of Donald Trump and someone put the head of Elon Musk on, I don't know what their names, Nancy Kerrigan and Tanya Harding.
Oh, wow.
I absolutely lost it. I was like, I can't even take this seriously.
Yeah. And I think that's the best thing to do as somebody that is focused on economics and wealth is little chuckle,
Little chuckle.
try to figure out where the markets might go. At the end of the day, this is how my take on the election is less about the emotion behind who I thought would do a better job. I was like, I don't really have a ton of control on this. I'm going to cast my vote. It's my duty as an American. But at the end of the day, I got to figure out how this is going to affect my portfolio and what I'm going to do next.
Yeah.
And I don't think it's any different now. So you have Tesla shares have looked to have been pretty impacted by the feud with Donald Trump. Anytime you have two big power folks, I think the thought process behind the share price falling is more about what happens if Donald Trump actually takes away the subsidies that help the growth of Tesla.
Right.
Regardless of who's right, who's wrong, what Trump says, what Elon says, if that is part of this bill and it gets passed, it's going to hurt revenue for Tesla.
Right.
Everyone that owns those shares, I think the majority of the people that own Tesla understand that it can be a little bit of a roller coaster. But the people that have been in it since the beginning still looking pretty. So who's to say that it's not a solid company to continue to work through?
Are there any other notable companies that we can think of in the last 6 months that we've seen this type of turbulence?
I mean, I'd say, and we're going to really dive into kind of the tariffs, but you saw some, like the tariffs were one of those moments when we look back in history where there was so much uncertainty.
Yes.
And what was kind of expected was so far off from what was delivered in Trump's original speech that the markets just like seesawed real quick.
Yeah.
And like companies like Restoration Hardware, like there was a really funny, like hot moment where the CEO of Restoration Hardware was on camera and they were like, "Oh, you've been watching your share price?" And he's like, "Yeah, yeah, yeah." And then he like looked up at the screen and saw what had happened. It was like, holy shit.
Yeah.
Like, because, you know, a company that really has tighter margins and is tied to importing things that are construction and made, especially luxury items.
Yeah.
Restoration Hardware is an IKEA. Like massive effect if those tariffs stayed.
Right.
I think most people and you know, as we talk about tariffs later, the policy whipsaws, like the part of, I call it genius of Donald Trump, is you never know what he actually is serious about or what isn't serious about. So what's going to last for a day? What's going to last for 90 days? Is it a negotiation technique?
Right.
And
you just never know.
In the midst of that, the market is doing what it always does, which is trying to forecast and price things in, but tons of uncertainty, which leads to, you know, a lot of people that, you know, probably made a lot of money buying the dips, selling at the peaks. But day traders probably kind of love this. Long-term stockholders and people that evaluate company fundamentals, probably less significant because they're probably trying to buy at good value and hold for the next 10, 15 years.
I think so that there's a strong argument to be had that through a lot of this turbulence that first initially happened once we saw even the announcement of the speculative tariffs actually happening was that we saw a lot of billionaires who are absolutely some of the top investors in the world dumping a lot of what they had and moving and allocating those.
Well, and there's two arguments there. One is, like, if you feel like what's happening in the world is so telegraphed and you can say 80% chance that a stock price is going to drop significantly and you sell it and your goal is to buy back in, like that's one strategy.
Right.
But I will say sometimes it's hard to buy back in. You know, sometimes it's hard to buy back in at the right price. And then, you know, it gets a little bit more complicated than that. But I know lots of people, and, you know, at Viking, we have over 1,000 LPs that invest with us. I've had conversations where people really, their strategy worked out really well for them. They made a lot of money over that time.
Yeah.
And I have other people who sold a bunch and felt good about it and then didn't expect the market to turn back around and didn't buy back in, and they're kicking themselves that they even sold when they did.
So that's a really good segue for me because one of the things that we're seeing with these policy changes is an influx in investor confidence. So how do you feel like there's been an impact in investor behavior and in capital flow for Viking and or just like what you're seeing in the investment world?
Yeah, when it comes to real estate, and I know we have a broader topic specifically about real estate, but the general confidence is high. I think people are still recovering from maybe investing at the top of the last real estate cycle, which I don't think anyone debates that there was a clear top.
Yes.
And then because interest rates and some headwinds that just kind of crashed into the real estate market at the same time, whether you're talking about retail or whether you're talking about hospitality or multifamily, which is where I focus, massive supply all coming online at the same time and high interest rates, a headwind that most markets wouldn't face. You compile that with historically low cap rates, recipe for a top to bottom scenario.
Right.
So I think people have been kind of reeling about that. But people are hopeful, they found the bottom. And
Do you also feel like some of the turbulence in the marketplace is also adding a little bit more fuel to the real estate fire?
Well, I think it did. So I think
Okay.
when you saw the little mini crash correction, whatever you want to call it, really what was kind of circled around tariffs, like the conversations I had with people, and it's like, damned if you do, damned if you don't, right? So people, when the market's high, they're like, oh, the market's doing really, really well.
Yeah.
I don't really want to take any of my chips off the table and put it in real estate because the market's been killing it for me. If I would have done that 2 years ago, I would have been happy. And then it drops, and it's like the opposite scenario. They're like, oh, I lost so much in the market that I really don't want to take chips off the table because then I lock in my losses. So,
You're just handcuffed.
Everyone's looking for a reason not to create movement because you're scared when you unallocate from the market. There's usually a tax burden, so there's lots of things to think about. But I think that's one of the toughest decisions facing investors today because of the whipsaw. So you see a massive thing go down, and in your mind, you're like, man, I missed my opportunity to take 20% of my equities and put it into alternatives.
Right.
Because I think alternatives are at the bottom and the market's at the top. And then you're drowning in your sorrows, and 45 days go by, 60 days go by, and then the market's right back where it was, and maybe even a little bit higher than that moment where you think you probably would have sold. And you've been given a golden opportunity. Like someone's turned the clock back. The real estate market's only gotten healthier, and you have this opportunity to sell at the basis that you would have sold 45 days ago. But then you're like, what if it keeps going up?
That's like, what if
it keeps going up and I lock in all this tax burden and I sell it and I miss the boat and there isn't some major correction. So I think that's the part where, like, I'm not an expert on the stock market. I do my research. I follow it. I like to follow trends, but that's the thing that maybe it helps for us to help people cut through the noise is I'll never tell you that you should sell stocks. Even if you're one of my investors and have a great, strong relationship with you, I'm not going to tell you to do that and put it into this. But I'll tell you what I would do. And what I would say is if you feel like one market is really frothy or still overheated, or you feel like there's a chance for a big correction, and you look at another market and you love the market, you love the fundamentals, you love the sponsors, you believe in that story, and it's more of like at a bottoming out, and you think that there's a lot of the ability to catch tailwinds, then I think you really know the right answer, but you have to make the decision, because who am I to say that with the uncertainty in the policies that are going to get put forth and what's going to happen, who knows really what's going to happen? Just 60 days ago, everyone had gone from we're only going to have 2 rate cuts this year to now we're going to have 7 rate cuts this year to now we're maybe we'll have no rate cuts this year.
Right.
And 30 days it'll be different because there's just a lot of uncertainty out there. And the best thing to do if you're investing in the stock market, what I would implore people to do is to not chase the things that look super sexy or attractive, but really refocus on core fundamentals, cash flowing businesses.
Yeah.
In this type of market where there's a lot of uncertainty, yield, cash flow combined with potential for outsized returns is always the way to go. And that is traditional equities or alternatives.
Yeah. So you mentioned policies and the uncertainty around that. So what kind of policies are you most watching for to see how they evolve for their impact on real estate in the rest of 2025?
So I think a couple of the pieces specifically pertaining to real estate that are kind of, real estate people are watching them, but maybe not everyone's watching them,
Okay.
is um, transaction volume, which I think is really important. And you were starting to see this kind of in the last year, beginning of this year, big institutional players like going out, like feeling like we're truly at the bottom and buying like huge portfolios, 3,500 units, 2,500 units. Like that's a signal. That's a green flag. Things are getting better when institutions go from pencils down to maybe I can make this work.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
And what I would argue, I had a presentation with a big, sophisticated institutional investor, and we were in alignment on this. Like the last big institutional, I can't remember if it was EQR or KKR, but they bought like 3,500 units at like a 4.5 cap or 4.75 cap. And that was properties in the vintage of like 2015 to 2022. So a mix, kind of core, not value add.
Mm-hmm.
But a lot of times when we're looking at those models and we're talking about where we're going to exit these deals 3 to 5 years, we're underwriting to a 5.25 cap or 5.5.
Right.
So the institutions have different parameters than a more boutique firm like Viking. When they're buying a lot of units and they're high quality units, they're going to trade at a cap rate that you're not building into your model. And it's always good to be conservative and live on that outsize, but like it gives a little bit of hope that you're seeing a sub 5 cap on a big institutional purchase.
So what policy was this?
So the big policy that I think is kind of driving all of this is 2 things.
Okay.
One, it's the tax bill. So the tax bill getting approved is...
You're talking about the big, beautiful bill?
Big, beautiful.
Okay.
So like the idea that the opportunity zones are going to get reintroduced, slightly different rules. The capital gains rules that are going to right now they're not being attacked, but there's some worry that they could be attacked.
Okay.
And then the bonus depreciation rule that's incredibly important for commercial real estate because it is one of the largest ways for not only high net worth individuals, but bigger commercial real estate firms to shelter income by depreciating really large institutional assets. That's, I think, the biggest policy that's moving. Now, obviously, tariffs, and I don't know, we're ready to talk about tariffs.
Yeah, absolutely.
But tariffs is one that kind of, it could be a headwind or a tailwind, right? Depending on how you're looking at it, because it's definitely a headwind for development and new construction, because you're looking at properties that, or developing a property and the cost of goods might go up, cost of labor might go up. This is going to cause the value that you're going to create either to go down or the pricing to have to go up. And where it creates a little bit of a tailwind is if construction costs skyrockets, then existing multifamily that has high occupancy, that's already producing revenue, is going to be a better value at today's pricing if pricing is going to go up significantly over the future. So that's something that I think everyone has a keen eye on. And are we still going to talk about real estate in general at a later time, or is this?
Yeah, no, I actually want to. I like that you transitioned just to tariffs because obviously tariffs, supply chain, those are all big headlines that we've seen over the last 6 months, especially the specific word tariff. And there has been a lot that we've seen, everything from 90% tariffs to we're going to have some tariffs one day, and then the next day we've actually gone back to 0. And then we're going to go to everyone having the same amount, and then this and that. And there's just been so much turbulence and tariff this, tariff that. Trump said this, Trump said that. And there's been announcement after announcement, like daily for so much of the time of the last 6 months that we've seen. And so I think one of the things that I'd really like to bring up first, before we go more into the real estate side of things, is just how those tariffs have affected what we've seen of the chaos in the market. And you're free to kind of go anywhere you want. I have more questions about it, but I think it's really important that we touch on that.
I think broadly, the things that Donald Trump and his administration have identified as potential unfair play, I think there's some legitimacy to it. I don't know that it's the most important thing in the world today,
Right.
but I don't think that America is going to be worse off for riding the ship with trade imbalances. And I think that there probably is a path forward. I do feel like it's been a little bit of a circus.
Yeah.
And because it's been a little bit of a circus, it's caught.
Hey guys, I hope you play the music there.
Yeah, well, it has, and I think it's created a lot of the uncertainty, and I think that it's also it's created havoc and chaos around kind of political decorum.
Oh yeah.
And leaders dealing with leaders, and leaders dealing with America, and America dealing with other countries. Like, this is where I feel like maybe it could have been handled better, but at the end of the day, like I have less control over whether it's a circus or not. I am very interested to see what the end result is.
Mm-hmm.
And if at the end of the day, the result is positive, I'm not going to argue about there being a circus.
Well, and if I may, what do you think is, I mean, obviously I know you know a lot about real estate, but what do you think is the most impacted industry so far from what the tariffs have done already? Or
I would say that the most impacted is probably really should be retail.
Retail? Okay.
Although it seems as though all of the enormous tariffs that have been talked about really haven't come to fruition.
Mm-hmm.
But who would always be hit the most, if you think about it logically, are the people that have been able to take advantage of outsourcing labor and cost of goods to other countries for years and years and years and years. I feel like there's an argument to be made that probably wasn't the greatest idea for America. Some people say those jobs are jobs Americans don't want. Fine. Like, I'm not going to argue about that. But at the end of the day, like, when those people lose that competitive advantage, it's going to hurt their revenue. Right. Just like if we make it more expensive to live in America, it's going to hurt a renter's ability to pay rent, and we might have more delinquents. Right. It's just cause and effect. So if you take away a huge competitive advantage from one industry, that's who I think would be hit the hardest. Yeah. Just like auto manufacturers that already manufacture in the United States, not worried about it.
Right.
If you're Ford or one of these other American companies that moved your facilities to Mexico, there were a few moments there where you were probably, scared a little bit and really, scrambling to come up with a plan. What if he's serious about this? Like, what if there aren't inclusions, or what if we can't negotiate a way to be let out of this deal? In any event, I think that if it leads towards more fair trade, the end result for most Americans isn't going to be as significant as the talking heads on TV kind of make it sound. Like, in my mind, if I wanted to go buy a Ford F-150 tomorrow, and it costs 20% more, I probably wouldn't buy a Ford F-150. But I'd probably buy a Ford F-150 that's 3 years older and one that isn't being charged tariffs. I'd be perfectly fine having maybe not the upgraded radio stereo or the new features.
Right. Because you don't buy a car for the radio, you buy a ticket.
And I think everyone deserves to want a brand new car or brand new clothes or whatever. But I feel like a lot of what America has become is this like consumption giant of the world. And I don't know that it's going to hurt America that much for people to be a little bit more thoughtful about where they're spending their money.
Yeah. No, I understand that perspective. I would say,
at least for a short time,
that this is just like half of the year we've seen this, and there's still a lot of uncertainty surrounding the tariffs. From what you know, with the tensions that have unfolded, the last bit of announcements where we have extensions of timeframes for decisions to be made, how do you foresee, or what have you heard, the effects will be for the rest of 2025?
Yeah, like I think where it's affecting me the most in my role at Viking is we're doing a development deal.
Yep.
And there are some things that we've had to adjust in our model to account for slightly higher prices, or at least risk or contingency, like the lender requiring a little bit more contingency just in case things go up in price. You protect yourself by, structuring the deal to be as safe as possible. But the opposite side of that is really great tailwinds for development because there's like almost no new supply coming online because most people aren't willing to go through the brain damage of figuring out how to get development to work, convincing the equity that it's a good time to develop. So if you're the group that's developing in a time and you deliver into a time where no one else is delivering, the supply demand economics that are hurting multifamily right now are behind you, and you get to ride the tailwinds a little bit. So I think
Right.
that's one of Viking's huge shifts is we're doing our first development deal with a really trusted real estate developer, and we're planning on baking that into our uh, plan and track for the next 2 to 3 years at least.
Absolutely. Well, it makes a ton of sense. So one of the things I wanted to ask you about, I feel like you gave me the perfect transition actually, because I want to dive a little bit more into real estate. And specifically, you spoke already, you touched on cap rates, you touched on, rent growth and supply chain issues and new development. Kind of what I want to know is a little bit more about what headwinds and tailwinds you see that are going to affect the overarching multifamily market moving forward for the rest of 2025.
Yeah, and I think there's immense opportunity if you really take the time to think about it and you're deliberate about where you're investing, how you're investing, and who you're investing with. So a good example is this development project, and you were with me at the groundbreaking.
Yeah.
Fantastic. And we're at this property, and I even noticed that like folks that were there, like we did a tour of another property led by the same developer, and the main difference between the two properties was one, like technicality. If you look at the like a map and you kind of scope out which is a better area. The other one is probably a better area, bigger property, and is right across from a huge hospital complex. Seemingly has everything going for it. However, it was developed 2 years ago, and it's now being delivered into a market with a lot of supply, and it's being
A
delivered
lot of competition.
a lot of competition. We drove around.
Yeah.
We left our area and made it down into Mesa, and boom, every corner there was a brand new like
Yeah, it wasn't even like they were like older. It was like everything had just been delivered right before now.
So even some of our investors that were there for our groundbreaking, that was impressive. You had the city talking about how it was going to be a catalyst for the area. You had, like the mayor's team there. You had lots of support. When you drove around our area, not a lot of new multifamily. This was going to be an anchor property that they're hoping is
An
going
entire
to
city.
blow up Peoria
Yeah.
and bring the retail and bring everything. You go to the other property and it feels different. You're like, man, there's like a multifamily place on every corner. There's a Starbucks over there. There's a brand new Chick-fil-A. There's this hospital system, but there's also 1,200 brand new units that this property now has to compete with. And its absorption, instead of taking 12 to 16 months, is projected to take 20 months.
Yeah.
And
That's brutal.
you think about it less from which one would I live in and which one would I invest in. And it's a no-brainer. The one that's done 2 years later, that's a little bit smaller, that isn't having to compete with all its supply, is a better investment. But that wasn't even clear to investors on site.
I know.
After talking about it, they were like, oh, like what you're saying makes sense. And that wasn't really clear to investors until we chatted about it. And then, they're a little bit more reasonable, but still, they're like, I like the other area better.
Yeah. Which, I mean, I guess it makes a lot of sense.
Yeah, the big thing that I always try to explain, and this is the tough part between development and acquisition, is with development, it shouldn't feel obvious that where you're developing is the next place. Because if it is, then everyone's already doing it. So you really have to trust that you have the ability to forecast and that you really can read the path of progress and you have good contact with the city and you really believe that they're going to invest in that area. Because once it's already been discovered, then some of the gold is.
Yeah. No, absolutely. So I have 2 more questions for you. Sure. So how should investors adjust their strategies in response to what's going on in today's market?
I mean, in my opinion, my humble opinion, I would say just be a little bit more cautious.
Okay.
So I wouldn't, like, a lot of people see the uncertainty, and it seems to me that everyone that I talk to that's trying to make money wants to make it as quickly as possible. But the one common thread that I can see with every really, truly successful person, our biggest investors, the most institutional groups, is they're like, if you have really good confidence that what you're doing is right, then create a strategy that's a long-term strategy. So if you think there's a 90% chance you're making a good decision, like liquidate, sell at the right time, buy at the right time, do those things. But anytime you think you're going to be able to take advantage of a moment in time and you're going to have to take a bunch of extra risks to do it, not worth it.
I love that advice. Okay, so for my last question for you, how can investors use this moment and what's going on to take advantage and make themselves successful for the next upcoming real estate cycle?
Yeah. It's a really good question. I would say specifically real estate.
Yeah.
Yeah. So I would say look in some of the areas that were hardest hit. So think retail, think some kind of core, maybe higher end value add. Think even, dare I say, hospitality, or even office. Some of these areas that, just the analogy I just made with the development, some things that don't look obvious today. Retail has performed a little bit stronger than people thought. And with multifamily, the absorption. So we've talked about all this high supply. People are in the industry are shockingly amazed at how much absorption has happened, which means when you have a ton of supply and the absorption can keep up with it, that's a recipe for tailwinds kind of picking up the market. And then the last thing I will say is, don't let hindsight and mistakes that you maybe made, sponsors that you worked with, things that you've done, take you completely out of a certain market. Those are expensive mistakes, but look at those mistakes as, like almost like paying for college. Like it should have made you stronger, better, and you should be able to trust the strategies that you thought had amazing fundamentals and do it better this time. Not just completely admonish it, because I think a lot of the issues that came from multifamily specifically were timing based and debt based more than execution risk.
Well, thank you so much for all of that insight. I think that this was an extremely valuable and honestly, one of my favorite episodes. I love that we're doing kind of like an end of season wrap up. I only have one more episode left, and you don't want to miss it. It's going to be with the CEO of Viking Capital, Vikram Raya. And to all of our listeners who've been loyal throughout the season, thank you so much. And we're very excited for our finale, and we will be back in the fall. So keep an eye out for all of our new season launch, and we'll be in touch soon. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.